Welcome to our weekly market review. It's brought to you by ETM Analytics and TreasuryONE. As per usual, I'm joined by TreasuryONE's own currency strategist, Andre Slier. Andre, it was a big weekend, a couple of important things happening. None of them got to do with rugby, of course, so that's to the side. But the big one, and it's obviously the point of discussion going forward into this week with the data coming out of the US, but that was the non-farm payrolls data out on Friday. Far below expectations, coming in at 22. I think expectations was 75K. So really a very big disappointment. And you know what? It's now been, 2 years, but more than 2 years of us calling for the labour market's going to weaken, and it seems like it's finally arrived in the US. And it's coinciding with recession indicators all flashing red. And of course, the low figure that came in from the non-farm payrolls had markets moving, now pricing in, I think it's almost 100% for a rate cut. But now the question is not just only 25 basis points. There are, of course, these murmurings. Has the job data disappointed enough to perhaps see Fed Chair Powell and his team move towards a 50 basis point cut? But that seems a bit far-fetched at the moment.
Yes, good afternoon to everybody. Now, interesting. We've been speaking about this upcoming Federal Reserve market meeting for quite some time now. As you've correctly mentioned, payrolls, we've been speaking about that a heck of a long time now. The one parameter that the Federal Reserve looks at is job employment. You know, that's one of the measures. Now, so if you look at the data that's been released, you've mentioned that it was expected at 75, only came in at 22. On this graph, there's a small little red blip. That's most probably the more important one for me, because that, and we've mentioned that a week or two ago, that every time that the figures comes out, the revised figure is revised lower. This time around, the June figure was not just revised lower, it's actually in the red. So it actually shed jobs rather than add any jobs. So two ways of correcting this for the Federal Reserve. Wait for somebody to be fired because they've released the wrong figures in terms of what Donald Trump wants to see. He does these things. Or adjust your monetary policy so that that supports the economy. Now, what the markets are telling us after this was released on Friday is that immediate move in the dollar, and that went weaker. Gold jumped up significantly. It's now trading above $3,600 an ounce. And the rand had benefited from that. And the possibility of an interest rate cut by the Federal Reserve now lies around the 85 to 90% chance. So that can almost be regarded as a definite. In between, and this week, we will be seeing the inflation data. Now, the next graph will bring us a little bit closer to that, because there's now talk that they might even go for a bigger cut. However, inflation also being one of the parameters that the Federal Reserve looks at, most probably will pick up a little bit. And that will be because of tariffs that comes through in pricing on automotive and cars industries, and that pushes up the inflation slightly. So tariffs are having an effect, as Mr. Trump warned. On certain goods, there's a pushback by the consumer simply not buying it because they don't like the higher pricing. But that simply says that the economy and retail sales might be under pressure and so forth. Hence, an interest rate cut will be able to put more money into the hands of the consumer and then being able to afford a slightly higher price. But with inflation most probably ticking up, chances of a 50 basis point cut, I would place at this stage below 50%. And the 25 basis point cut, a definite 95 or so percent chance of that actually happening. What will
Yeah, I
that do
think
to the dollar? Well, chances are that if that comes through, as we now say, that people will start speculating on a second cut, looking further down the line, and that could further weaken the dollar.
that's right. Yeah, I think 50 basis points is stretching it at the moment for the next meeting, but we will have to continue tracking all this data, the CPI and labor, to really see. And of course, the uncertainty around the tariffs, with the court stepping in and no one knows really what's going on. We're still waiting for that thing to settle, which feels like it's never going to. But of course, the other big happening of this weekend was the Japanese Prime Minister handing in his resignation, which obviously had an impact on the yen. It slid, and that sparked some hope for some carry trade attractiveness, which obviously could boast well for the rand, right, going into this week.
Definitely. The rand has benefited quite substantially over the last couple of months already because of positive carry trade, and we just have to look at our bond market, where lots of bonds was bought by foreigners because of the carry trade, lots of inflow, and that obviously benefited the rand. If we look at the gold price and we were in the 80s and the 90s, we would have definitely seen a further strengthening of the rand, but that kind of flown a little bit because of our mining industry and our gold production. That's not at the same levels as it used to be. So the impact of that is still not as much as one would have hoped for, because of less mining, less production, less gold, so a smaller percentage of GDP. It nonetheless still puts our trade on a positive figure, so there is some benefit of that. But mainly the rand benefited and is on the front foot because of the weaker dollar. And we've discussed that now. That's because of the possibility of an interest rate cut. And if they start speculating about a second cut after the first cut, we could see some further benefit. Add to that a Japanese yen that weakened, and also more carry trade that could possibly come in there. And with lower interest rates, investors more and more willing to put money into emerging markets because that would benefit the risk on such a scenario. We could see a rand most probably trying to break the 1750 and move closer to the 70 levels, but definitely not this week or the week thereafter. I'm now talking most probably over the next 2 to 3 months. Is that a certain possibility? But for the moment, guess what? We still in that wonderful band, 17 and a half, 1770 on the narrow, and on the wide, 1750, 18. I doubt whether we're going to break that very soon.
Along with the US inflation data, there's obviously some domestic data that's also set to come out this week, GDP being one of them. So a couple of interesting states that I think is just going to give us a new view of the lay of the land when we chat again next week. Andre, thank you so much for your time.
Thank you very much.